I want to draw your attention to two issues that emerge as we complete the audit: contingent liability testing and subsequent event testing. These tests can only be done after fiscal year end and represent significant audit challenges. So you may recall from prior accounting classes that contingent liabilities exist when the client or management may have a debt or obligation that's uncertain. It could be uncertain in the amount or whether it's even going to occur. The auditor's job is not to record these transactions, but to verify management has properly addressed the underlying events. If we look at the accounting rules more specifically, if the likelihood of the contingent liability materializing is remote, then the client is not required to do anything and is unlikely to do anything. If it's more than remote, but not probable to occur, then the client must disclose it. And so now if it becomes probable and the amount can be reasonably estimated, then the client has to recognize the transaction. When we think about management's incentives, it's fairly obvious that they would be pushing for contingent liabilities to just be disclosed or not disclosed at all. The reason is, when you record the transaction for a contingent liability, you will associate it with an expense. When you have an expense, you're going to reduce the bottom line. So the management's going to be pushing for disclosure. So they might claim it's not probable, we can't reasonably estimate the amount. So there's a lot of different contingent liabilities we could be talking about. We could be talking about warranties, taxes, lawsuits. And so you're going to see a lot of that come out. The auditor's job is to find them, to make sure that they're there, because we're going to be dealing with a lot of completeness concerns. And so how are we going to find them? We'll read the board minutes. If there's a major lawsuit pending or warranty issues, we'll expect them to be disclosed there. We'll read legal agreements to see if there's penalties or other clauses. We could read the tax filings to see if those have been properly addressed. We might confirm with creditors what are the debts and obligations of the company. We could talk to the client's legal counsel. Again, could be the general counsel or the external counsel. We're going to definitely make this an issue we address in our correspondence with the outside counsel. And we'll talk to management about this. We'll inquire of them, and we'll ask that this be explicitly stated in the management letter at the end of the audit. Subsequent event testing is a little more complicated because not all things need to be addressed in the same way. When we think about an audit, we normally think about the typical timeline of fiscal year end of 12/31. The auditor does their work until some future date, and then at some point after that, the auditor will issue their report. And so now the auditor's obligations vary. And so a subsequent event where the underlying event happened prior to year end will require the client to adjust the financial statements. So something happens after fiscal year end, but it informs what was going to happen, what existed before. So for example, the client has a major receivable that was on the books, the underlying economic transaction happened, but after fiscal year end we discover they cannot pay the bills. We would need to adjust we would need to require the client to adjust the financial statements. So the client will be the one making the adjustment, not us. Now, sometimes something happens after fiscal year end that impacts how you would interpret the financial statements. A merger, a major lawsuit for events not existing at year end. So we're going to need to have those dealt differently. And so they're going to require disclosure. And so again, the client is always going to push for disclosure over recognition on bad things. On good things, they're much more flexible about early recognition. So after we've done all our field work, what happens if we discover more? Well, we have two options. If after we've done our field work, we learn of something. Well, one, we can go back and expand all our field work so that everything is up to date, because we don't want, we can't just be so narrow in our focus. The other option is to be narrow in our focus and do what's called dual dating. So an audit report where we go back and expand all our field work, we will say the audit was completed and this is when the field work was done. Now, if we want to restrict our focus, we would say everything is fine except for this one narrow issue which was accurate as of the subsequent date. Now, clients obviously don't prefer dual dating because it's going to highlight, it's going to put a big spotlight on an issue. So the more common option is to not dual date, but to expand all audit testing. Not always practical. Client may not be willing to pay for it. So we're going to need to work with the audit committee on that. So this figure here kind of summarizes where we're at. The subsequent event testing period, or a subsequent event period extends from the balance sheet date to the report date. The auditor needs to be aware of what's going on in this time period, do things. If something is discovered after the field work, but before the report date, then we'll have dual dating. Now you'll note in the timeline I posted there, it's a rather long window of almost 20 days. In recent years, that window has shrunk, due to SEC changing filing deadlines for public companies. But just practically speaking, the less time there is between these two dates, the less the likelihood of a dual date occurring. Now, there's also the possibility that after the auditor issues their report, they learn something. And so the auditor is under no obligation to actively continue to seek out information after they issue their report. But if they discover something after they issue their report, they've got to go through some tough questions. Did that information exist at the report date? In other words, should the auditor have reasonably known this? Is the information they received reliable? Rumors are not relevant. Have the fieldwork standards been followed? In other words, did the auditor comply with the professional requirements on how they would gather and collect evidence? If they were negligent in how they collected evidence, then they have a greater responsibility. If people are still relying on the auditor's report, they have greater responsibility. So for example, if you discover something about an audit report you issued 3 years ago, you could reasonably say no one is looking at the audit report from 3 years ago, therefore we have no responsibility to correct it. And so if yes to all of these, then you need to do something. So you would work with the client to revise the financial statements, inform the SEC, regulators, notify the board. Again, you can't revise your financial statements. You could withdraw your opinion or revoke your opinion. There's a lot of options, but you want to do this in negotiation with the board of directors because maintaining good client relations is important. Even if this is still not your audit client, you want to maintain a good firm reputation that you work with clients, protect the integrity of the profession. So how will you actually discover subsequent events? It's basically a miracle, a nice little acronym on some of the procedures you'll go through to help discover them. So pay particular attention to this when you're going back studying on the difference between type 1 and type 2 events. You're going to see this tested explicitly and repeatedly. Is this a type 1 event? Is this a type 2? And so best of luck.